The Additional Standard Deduction for U.S. Senior Citizens explained. The Additional Standard Deduction is a tax provision that increases the standard deduction amount for taxpayers who are age 65 or older or legally blind at the end of the tax year. For the 2026 tax year, the additional amount is $2,050 for individuals filing as single or head of household and $1,650 for each qualifying spouse on a joint return. It's designed to provide extra financial relief to populations that often face higher medical expenses or live on fixed incomes. This amount is added directly to your base standard deduction, which for 2026 is $16,100 for single filers and $32,200 for those married filing jointly. The criteria for using this deduction are primarily based on age and vision status. To qualify for the age-based portion, you must be 65 or older by December 31st of the tax year. Notably, the IRS considers you to be 65 on the day before your 65th birthday. To qualify for the blindness portion, you must be legally blind, meaning your vision is 20/200 or less in your better eye with glasses, or your field of vision is 20 degrees or less. If a taxpayer is both 65 or older and blind, they are eligible for double the additional deduction, effectively receiving two separate add-ons to their standard deduction. How this works is relatively straightforward. It stacks on top of your existing standard deduction to lower your taxable income. For instance, in 2026, a single taxpayer who is 67 and legally blind would take the base $16,100, add $2,050 for age, and another $2,050 for blindness, totaling $20,200 in deductions. For married couples, the deduction applies to each spouse individually based on their own eligibility. If both spouses are 65 or older, they would each add $1,650 to their joint base deduction of $32,200, resulting in a total deduction of $35,500. The primary benefit of this deduction is that it reduces the amount of income subject to federal tax without requiring the taxpayer to itemize. This is particularly advantageous for seniors because it helps shield Social Security benefits and retirement distributions from being taxed. Additionally, recent legislation, namely the One Big Beautiful Bill Act, introduced the temporary enhanced senior deduction of up to $6,000 for individuals, $12,000 for couples, that can be claimed alongside this traditional additional standard deduction. This layering can significantly increase the tax-free income floor for many retired Americans. Changes to these amounts happen annually through IRS inflation adjustments based on the Consumer Price Index. While the base standard deduction and the additional amounts usually increase every year to keep pace with the cost of living, significant structural changes often come from new legislation. For example, the One Big Beautiful Bill Act made the higher standard deduction levels from the 2017 Tax Cuts and Jobs Act permanent, while introducing the extra temporary senior deduction through 2028. This means that while the regular additional standard deduction for age and blindness is a permanent fixture, the newer $6,000 bonus is currently scheduled to expire. U.S. taxpayers need to be aware of several concerns, including the income phase-outs associated with newer senior-specific benefits. While the traditional additional standard deduction for age and blindness has no income limit, the temporary enhanced senior deduction of $6,000 begins to phase out for single filers earning $75,000 and joint filers over $150,000. Taxpayers should be cautious about tax cliffs, where their total income might disqualify them from certain credits or increase the taxable portion of their Social Security. Finally, because the newest senior deductions are temporary, those planning for retirement after 2028 should consult with a professional to account for the potential sunsetting of these larger tax breaks. We welcome you to subscribe to our YouTube channel for more informative videos on taxes, investments, and retirement. Thank you.